What if I told you the best investor in the world is not interested in buying the best piece of real estate in the world? Sounds crazy, right? Well, that's exactly what Warren Buffett, the billionaire CEO of Berkshire Hathaway, thinks about the commercial real estate market. In this episode, we're going to explore why Buffett is avoiding commercial properties and what he is investing in instead. Hello and welcome to Fun Financial Insights, the channel where we make finance fun and easy to understand. Today, we're going to talk about a hot topic. Is a commercial real estate crash coming? And what does the legendary investor Warren Buffett think about it? Commercial real estate, or CRE, is the term for properties that are used for business purposes, such as office buildings, shopping malls, hotels, and warehouses. These properties are usually rented out to tenants who pay rent to their owners or landlords. Sounds like a good way to make money, right? Well, not so fast. The CRE market is facing some serious challenges right now, and some experts are predicting a crash that could wipe out billions of dollars in value. What are these challenges, you ask? To understand the challenges, first you need to understand how commercial properties are purchased and how their relationship is with the economy. You see, commercial properties are usually more expensive and complex to buy than residential properties because they involve more legal, financial, and technical aspects. Big financial companies such as investment banks, hedge funds, private equity firms, and insurance companies are often interested in buying commercial properties because they can offer high returns, diversification, and tax benefits. To buy a commercial property, big financial companies usually use a combination of equity and debt. Equity is the money that a company or its investors put into the deal, while debt is the money that the company borrows from a lender, such as a bank. The ratio of equity to debt is called leverage, and it affects the risk and return of the investment. The higher the leverage, the higher the potential return, but also the higher the risk of default. One of the most important factors in buying commercial property with debt is the interest rate. The interest rate is the cost of borrowing money, and it can vary depending on the type and terms of the loan, the market conditions, and the risk involved. When interest rates are low, borrowing money is cheaper, and buying commercial property is more attractive. Low interest rates can also stimulate the economy by increasing consumer spending and business confidence, which can boost the demand and value of commercial properties. Low interest rates can also create a bubble where prices rise above their fundamental value and investors become overconfident and over-leveraged. When interest rates are high, borrowing money is more expensive and buying commercial properties is less attractive. High interest rates can also slow down the economy by decreasing consumer spending and business confidence, which can reduce the demand and value of commercial properties. To illustrate the relationship between CREs and the economy, let's look at examples from history. Before we continue, I want to remind you to smash the like button and leave a comment below. Let us know what you think about commercial properties and how they affect the economy and banks. And if you are new here, please consider subscribing to our channel and clicking the bell icon so you can get notified whenever we upload a new video. In the late 2000s, the U.S. experienced a global financial crisis, which was partially caused by the collapse of subprime mortgage market, which involved loans to borrowers with low credit scores or income. Many of these loans were securitized and sold to big financial companies who used them to buy commercial properties or other assets. When the housing market crashed, many borrowers defaulted on their loans and many commercial properties lost value and became vacant. As a result, many big financial companies suffered huge losses and faced bankruptcy or bailouts. This also affected the banks that lent money to them, who also faced losses and liquidity problems. This caused a credit crunch, which slowed down the economy recovery from the recession. To the challenges the CRE market is facing right now, some experts predict a crash that could mean billions of dollars of value wiped out. Now, what are those challenges? First, there's the pandemic. The pandemic has changed the way people work, shop, and travel. Many people who are working from home, shopping online, and avoiding travel. As a result, many CRE properties are sitting empty or underutilized, and some tenants are struggling to pay their rent or asking for rent relief. Second, there's the oversupply. Even before the pandemic, the CRE market was already saturated with too many properties, especially in certain areas. For example, according to Forbes, there are over 1,100 malls in the U.S., but only about 300 of them are profitable. The rest are either losing money or barely breaking even. Third, there's the interest rate. Interest rates affect the CRE market in two ways. One, They affect the cost of financing for the landlords, who often borrow money to buy or build their properties. And two, they affect the value of the properties, which are based on the expected future cash flows from the rents. When interest rates are low, the value of the property goes up, and when interest rates are high, the value of the property goes down. Right now, interest rates are rising, and they are expected to rise even more in the future. This is bad news for the CRE market because it means higher financing costs and lower property values. This means that the landlords have to pay more interest on their loans, which reduces their profits and cash flow. At the same time, the rising interest rates also lower the value of the properties because the future cash flows from the rents are discounted at a higher rate. Landlords may have to sell their properties at a lower price or face the risk of defaulting on their loans. So what does Warren Buffett think about this situation? Well, as you may know, Buffett is not a big fan of CREs in general. He prefers to invest in businesses that have durable competitive advantage, high returns on capital, and low capital expenditures. He once said, "I'd rather own a wonderful business than the best piece of real estate in the world." Now, that doesn't mean he ignores the CRE market completely. In fact, he has made some investments in the sector over the years, such as buying a stake in the real estate brokerage firm Home Services of America, acquiring a portfolio of manufactured home commodities, and leasing out some of his own properties to other businesses. Some of Buffett's other stock filings also revealed that he bought shares of 3 home builders, D.R. Horton, Lennar, and NVR. These are companies that built and sell residential homes, not commercial properties. Why did he do that? Well, one possible reason is that he sees more value and growth potential in the residential market than in the commercial market. The residential market has been booming in the past year, thanks to low interest rates, limited supply, and high demand from buyers who want more space and comfort in their homes. The home builders have been reporting strong earnings, revenues, and orders, and their stocks have outperformed the broader market. But what about the commercial real estate crash? Is Buffett worried about it at all? Well, he hasn't said much about it publicly, but we can infer some of his views from his past comments and actions. Buffett and his partner Charlie Munger answered a question about the U.S. commercial real estate market at the Berkshire Hathaway annual meeting once. They warned that the market is facing a storm due to high borrowing rates, falling property prices, and non-recourse loans, which are loans that allow the borrower to walk away from the property without any personal liability if they default. Buffett also shared his views on the commercial real estate market in an interview with CNBC. He said that people who lend too much money to commercial properties should take losses, and that banks can handle loan losses as long as they have enough capital to protect their depositors. He also said that there is no reason for investors to panic and that some banks may decide to hold the properties for a long time until they recover. While we don't have any new information from Buffett about his stance on the commercial real estate market, we can assume that he is still following his own principles and strategies. He is not buying or selling any commercial properties, but he is watching the situation closely and ready to act if he sees a bargain. He is more focused on the residential market where he sees more opportunities and value. He is also prepared for inflation, which could hurt some of his investments but also help some of his others. Well, I hope you enjoyed this episode and learned something new. If you did, please hit the like button, subscribe to the channel, and share this video with your friends. And don't forget to leave a comment below and let me know what you think about Warren Buffett and the commercial real estate crash. Do you agree with him? Do you disagree with him? Do you have any questions or suggestions for future topics? Let me know, and I'll see you in the next episode. Until then, stay safe, stay smart, and stay fun.